So welcome back to episode 3 of Exploring the Process. Hopefully you really enjoyed our session and chat with Joe Cat last week. We certainly had a lot of fun, with that conversation between Chris, Joe, and I. This week we've got an awesome guest as well, trendwhizo, as at trendwhizo is his Twitter handle. He's going to remain anonymous today, just because of basically some underlying kind of business issues. He's just going to need to kind of keep that his little logo up there for everybody to see. But he's gone beyond and beyond basically a conversation, and he's actually created a whole slide deck for us in Hedgeye Nation here to review, and we'll be kind of parsing through that, as well as getting a better understanding as to how he discovered Hedgeye, and some of the mistakes he's made obviously over time. You're going to see this is a pretty similar theme, right, Chris, in terms of discovery, mistakes, learning, improving, and kind of where we are today, right? So that's the goal, and hopefully you guys are enjoying these, and we're really excited to get this session kicked off with Trent. So welcome, Trent.
Good morning, everyone. Hey, Rob. Hey, Chris.
Hey, buddy.
Excited. I'm really pumped. I hope Hedgeye Nation finds this useful, and I look forward to our chat here.
Yeah, and just because I know we'll get this question, Trent. Yes, the slides will be available eventually, but we're gonna make you listen to the whole thing, and that kind of right. So so we know you'll be very excited and very eager to get them. That's one of the best things about Hedgeye Nation, to be honest, is the level of kind of consumption that everybody loves to do, right? I mean, Chris loves his, it's cool. He calls them janky spreadsheets. I think they're pretty darn special. But you love your data. Trent loves his data as well, and many of you out there do too. So to start off, Trent, why don't we kick it off with maybe kind of how you found Hedgeye, and how your journey started down this path.
Sure. Let me pop up the slides. Go in that order.
That'd be great.
Yeah. So do you see my slide?
We can. And if you hit the little
excellent.
slide button, if you hit the slide deck, then it'll be a little bit easier to see the main screen.
Oh.
Right now we got maybe display settings, actually. I click that one.
Display settings. Okay. Are you able to see the PowerPoint slideshow though?
We can. It's just it says next slides and no notes, so it might be just a little easier if we just get the main.
Okay,
page
let me
up.
go to the main slide. Yeah. Okay.
Yeah, perfect. Yeah. Now this is it, guys, because we actually tested this a minute ago and it worked perfectly. So there we go. See, this is real time. This is raw. Right. This is raw. This is new. This is us learning our process, right? Hey, Chris?
Of course. Great. Just for the sake of our viewers, so that they don't get any incorrect impressions, this is a disclaimer. I'm just putting it out there. There's no assurance of any investment strategy, and this is only for information purposes, doesn't constitute any solicitation of security. You have to do your due diligence and so on and so forth. We decided
that's Trent's way of saying find your own path, right? Find your own process.
Yes, process.
Yeah, exactly.
This is my process.
yeah, totally, man.
There you go. So the title I gave to the overall deck is #process.
Exactly.
All right. So my background, I'll give my background. I'll also share about how I found Hedgeye. My background is I've been investing or trading for over 22 years. By education, I'm an engineer, as a computer science engineer undergrad. That was a long time ago. I did my graduate from Carnegie Mellon, and then CFA about in 2010. You can follow me on trendwhizo Twitter handle. Going back to Rob's question about how I found Hedgeye was at the Traders Expo in New York. I ran into one of the associates. I signed up for a trial version, and I even got the merchandise. I got the hat. I still have that hat from 2013, the Hedgeye hat.
I like that.
And then after that, briefly for a period of a few months, I did subscribe. I went through the process. It was not as evolved as today. And honestly, at that time, I discontinued because I had some personal matter I had to take care of, and I wasn't as actively investing. So from a subscription standpoint, I was wondering whether it makes sense for me or not. Once I was back, I had to go abroad. Once I was back, then I started exploring more about it because I started feeling something was missing in my reading process and in my overall investment process. And then I went back to it. And before going there, I asked a few of my hedge fund clients of whether they have heard about it, what do they think about it, etc. In the initial days, I think more than the retail subs, the institutional uptake was much higher for.
Sure.
So this is my background with the Hedgeye process, and the Hedgeye Nation wasn't as big. I think today it's very big, and I'm glad we are having these sessions. So thank you, Rob, and thank you, Chris, for holding this chat session. These are extremely helpful.
Yeah, absolutely. So then, going back, when you're saying that you were lacking some information, or you kind of primarily leveraging the, traditional tools, what have you, kind of some blogs, traditional tools for like the retail guy, right? So like some blogs, any other kind of, bank information, or kind of, any other kind of research you could have gotten your hand of from sell side research, that kind of thing.
Yeah. So at that time, I'll be very honest, I wasn't super structured in my approach as I am today. It has been a good learning process. Back then, I had just two primary accounts, right? One was my 401k account and one was my brokerage account.
Sure.
And in the brokerage account, it didn't seem like I was having a decent performance at all. Meaning, if I was underperforming the S&P 500 or even, let's say, a global benchmark index by 10 or 12%, which is a lot because those were not great years. So I was kind of running negative.
Right.
And I realized that I was missing something. And I'm thinking, why am I getting whacked sometimes? And why am I not being able to? And then I kept thinking that, okay, should I have a long-term view in this? And should I do something else? And that's around the time when I resubscribed and I realized that, hey, this kind of makes sense. They have a cyclical approach. And then initially, again, I was trying to get hold of my overall process that, okay, they're saying this, but how does that translate to my brokerage account? Because in my 401k account, there's just very limited changing of weights that I could do because the investment options are rather limited, right? But then actively managed brokerage account, how do I take care of this? So that's how I started way back when. And this is despite of the fact that I was a CFA. So I completed my levels of CFA in 2008, 9, and 10. And after 2010, I was great at security analysis. I sucked at portfolio management. Right.
Well, Trent, I mean, that's a huge thing, right? I mean, and again, you get a lot of even analysts on the sell side, right? That they have the CFAs, they're fantastic at their research and understanding the various components of the business entity and like what that translates to, valuing a company, but then taking that information and parsing it into kind of an investment approach or portfolio management. It's the big difference between even just the sell side and the buy side, right? I mean, but the buy side typically has a bit better handle on that kind of components. But then, for the individual person who might still be, CFA and charter holder or what have you, right? Even CFPs, right? Like they're still very, very accomplished, professionals, but just kind of have a different focus and, deploying that into your own accounts. I mean, I can't tell you a number of analysts that I've worked with over the years on the sell side that are just horrendous traders.
That was a lot of feedback from last week as well from Joe's interview, is that people got a lot from the sizing part.
Yes, it's extremely important. In fact, so I'll jump in.
But we can keep.
Yeah. So from my investment approach perspective, the way I started developing was I said, okay, there are several things that I did learn in CFA, which I'm not implementing. And I did learn from some of the hedge fund PMs that I was acquainted to because of my work back then. I used to provide consulting services to hedge fund customers. These were anywhere between 100 million to 2 billion. There was one outsized one too. I can't name them because of NDA, but they're basically one of the the largest hedge fund with asset under management, over $100 billion. So what I realized was, yes, I need to stick to my investment policy statement. I actually did not have one. And then second was, I wasn't treating it like a business. So it wasn't tax efficient. It wasn't having other benefits. I wasn't really looking at it. Say, for example, let's say if I had to think about my Hedgeye subscription cost, I used to keep wondering that, can I get a tax deduction on this? Can I do this? Can I do that? And then when I spoke with one of my business advisors, as well as a hedge fund PM, he explained to me, if you set it up like a business and if you create a plan like a business, then you'd run it like a business. That's right around the time when I also met an options market maker. I learned from his story too. He started his business in San Francisco about 2002, and he bought a lot of puts thinking the markets would go down, and then he failed miserably. Later on, he became a market maker by further getting more debt. And then this time, second time around, he was very successful because he learned the tricks of the trade from the pros. So I decided in 2014, when I came back from abroad, that I would want to set it up like that. So my approach is to treat it like a business since then. So I formed proper legal entities, which also make its flow back into my estate planning and everything, which makes sense. So I'll speak more about that later. And then the third point I would hit on is the core satellite approach, right? So the core is relatively passive management, and satellite are much more actively managed. They could be on a daily basis, weekly basis, whatever. There are a few satellites which could be passive, such as the merger arb one, but I'll get into that a bit later. So I'm expanding on all these 3 points in next set of slides. So treating it like a business, I honestly till 2014 did not know I could do this, but yes, I had to plan it like a business so that I could devote some resources towards research and development. I could have KPIs to measure the health of the business. I could decide how I'm going to ration my time. I'm not a full-time investor. I'm a home gamer. I think a lot of Hedgeye Nation retail subscribers are home gamers as well. When I say home gamer, I'm trying to distinguish myself from an institution, right? I'm not an institution with, say, 100 million asset under management, 1 billion asset under management to afford some of the bells and whistles that they have. So then I had to bootstrap my own set of things, which I'd seen as some of the best practices in the industry while consulting the hedge fund clients. Setting up operations, having a good execution plan. What do I mean by good execution plan? Let's say you got a good call from Hedgeye for quad 4 on a thematic basis, but you're trying to translate it into an execution plan. If you don't know how to do asset allocation, if you don't know how to do security selection, it would be challenging. In operations, there would also be the technology plan. So what do I mean by technology plan? Technology plan means, do you have the best execution place? Do you have the best broker? Are they giving you all securities available? Are they saying that stuff is not available to short when it actually is available to short with some other broker? Do you want to have multiple brokers for that reason? Business continuity and disaster recovery plan also is important here. And I'll take a pause after this one so that we can interact more. But the BCP part is so important. I had this one trader friend. He's a full-time trader, and he actually runs one of those services where he would do some weekly options and he would share those with people, and people pay him a subscription fee to watch him trade, right? Those kind of things.
Yep.
So he got once in a bad car accident for which he went through surgery, etc. But he had such levered positions out there. It hit him really hard in terms of now. So, if your internet goes out, if a broker platform stops working, if he's impacted, if you are impacted as a person, you need to have this plan figured out. If you don't have this plan figured out, it's a problem, right? So for example, something as simple as having a UPS, meaning a power supply backup. I've asked many people, they don't have a power supply backup for their computers. So if you're in the middle of trading, if you're doing active trading in one of your satellites, and your power goes off, you might lose a lot of money, right? And all these came to being, one, either because I've seen how professionals do it, or two, because I learned from my mistakes. And I'll show you how I learned from my mistakes when I talk about journaling. So I'll take a pause here, and go through the rest of it later. But do you want to tease out any specific part out of this?
No, go on, Rob.
Oh, I was just gonna. So what I was gonna share was, so Trend. My relationship with Trent has basically become exponentially grown since starting the weekly notebook reviews, and over that course of time, so to call it, last month and a half really is when Trent and I started to really interact more on Twitter and stuff like that. And he's opened my eyes to a number of things we talked on today, and one in particular is the platform piece, right? So I use Schwab and Fidelity currently as my two primary brokers, but he introduced me to another firm called TradeStation, and one of the big things that that resonated with Trend is the different, again, especially where we both have the day jobs, and is the varying ability to basically create kind of exit strategies on yours, to kind of create limit orders with kind of trailing stops in place, other bracket orders, et cetera.
Right.
So I'm just now, Trend, kind of learning that platform. I haven't transferred any assets over there, but it's from an execution standpoint, it's hands down much better from an exit strategy. I mean, really, Schwab only really has trailing stops, I believe, or at least the ones that I have access to, kind of trailing stops, and you can kind of put it in limit order. But their platform is definitely a little bit. Fidelity's better, but it's a very small portion of really. I only leverage Fidelity for my kind of like options book. But anyway, but these little things, right, in terms of having various components, and especially if you operate the way that you do, Trend, in terms of like having the satellite strategy, and sort of being like, okay, well, if I'm going to go take care of my core portfolio, it's going to be, again, I don't know where it is, but it'll be at Schwab. If it's the other one might be at Fidelity or whatever, and you might have a mix of everything everywhere. I'm not really sure, but definitely, for those out there, I know Leslie, for instance, uses the TD, the Think or Swim platform, and she's very, very happy with that. So there's a lot of different components out there, but definitely evaluate what you're doing, and where where the core book of your business is, and are you getting the best kind of tools at your disposal that are provided by the broker. And again, as I said, Schwab is decent, but they definitely, I'm hoping that with their acquisition of TD, they're going to start to pull in some of these other details, or kind of meld them together over time. But at the same time, why hope when you can, go and just make a switch and get something better right out of the gate. So anyway,
just for perspective, I mean, I don't really trade any of the US stuff. So in the last 2 or 3 weeks, I've started mainly because someone called me out on the arena that I was making a lot of posts and trying to help people like through their decision process, and then he picked up on an old slide of mine and he was like, well, what does it even matter what you say, because you don't trade any of the US stocks or ETFs. So why are you telling us about something about XLE or whatever? And I was like, that's fine. I get it. So coming from mainly FX and then more recently crypto, the broker that I set up with, I tried to short something came through on an RTA, and I was like, what do you mean there's no borrow? I don't understand. Like, what does this mean? Like, why can't I short it?
Yeah, I couldn't get at Schwab the other day. I couldn't get a borrow on Kane. I couldn't get a borrow on Kane. I couldn't get a borrow on. I could never get a borrow on one of the other ones that was on the list, like the emerging market ones. But it happens. It happens.
It happens. I actually faced that a lot back in 2013, 2014. I wasn't super active in 2013. I was trying to short something though because of some macro setup, but I couldn't get a borrow with my broker back then. So that's when I did a thorough research. I went through all the forums such as Elite Trader and a bunch of other ones, and then found out that people who do this full time, they have slightly different tools which allow them to do this much better. I've been I actively started using TradeStation heavily for my satellites. But also I wanted to touch upon these transaction costs over here. We take these for granted by, sometimes putting in market orders, or sometimes not thinking about whether your broker is giving you the best deal on commissions or not. But you can optimize this and you can put a dollar figure on this. And the way this started happening for me was, starting 2016, I started heavily actively trading in my satellites, and I found my broker commissions were bizarre. So first thing I did was I started taking my year-to-date number. I first started negotiating with my existing broker, and then when I realized that they were just giving me like a very marginal discount, I just took all my assets to another broker who gave me a sweet deal on all assets. I know that equities don't have commissions anymore, but even in options, if you're paying anything more than 46 cents a contract, and if you're trading more than 200 to 500 option contracts a year, go to Fidelity. Just tell them that, hey, I'm going to trade more than 500 contracts and I want you to give me the best deal. They'll probably give you whatever they think would be the best. And then you can take it from there. You can do the same with any of your existing brokers. Same for, I don't think you can avoid the transaction taxes or exchange fees at our scale, but if you get a DMA, meaning a direct market access broker, then you can deal with that in that fashion. There are implicit costs too, such as slippage, and one needs to factor this in. There could be unfilled trades. This has happened to me for some of my satellite strategies, such as, buy it at market on open. I've had unfilled trades because my code may have said buy it at 9:30:00, and the exchange decided to open it a few seconds later. Never happens on major exchanges, but on smaller exchanges that can happen. Or there could be a market impact, meaning, let's say a tiny float, 300 million market cap stock. I was trying to buy something in the options. It raised the prices of the option. So those kind of things you got to take care of in your execution. I was able to add almost 200 basis points to my returns back from then. I know in grander scheme of things, from convenience standpoint, people won't think that's enough. But if we look at our capital market outlook going forward, this year and forward, 200 basis points is a lot. So definitely want to optimize on that.
I think it's one of those things. Everyone wants all the chart porn on prices and what assets doing what and all these fancy ways of displaying the data. But as you've just said, it's just as important, not the price of whatever, the dollar. It's going back and looking at all your trade transactions and looking at what at what the actual costs are, all these little hidden costs before you've even started, about asset allocation.
That's true. And that gives us a good segue of, overall how I deal with my investment policy. I don't change it every often, but when there are major economic changes, such as, we had this quad 4 call, currently shallow, and then for Q2 deeper. Usually I would look at, the goals and risk preferences of different satellites, as well as my core, structure the portfolio, monitor report. This is a standard, procedure which you'll find with any of the advisors. Elaborating it further, when I execute this policy, these are key components. For me, I've found out that my asset allocation tends to drive most of my returns. This was especially between 2014 to 2016. I found that the passive portion of my portfolio, where I was touching my portfolio maybe just, especially in the 401k, where I was touching it barely once in 3 to 6 months, or maybe at the turn of economic events, or say quad shifts or whatever, I would only touch my asset allocation at that time. And that had much more gains as compared to my actively managed part of the portfolio. So think about it just for a moment, right? I'm doing so much effort on my active. This was between 2014 and 16, not now. my active was giving me much lesser return. So that led to some sort of disillusionment for me that, oh, does active even make sense? Like, should I just leave it in passive and I make much more money in that? So I just want to give a glimpse of this. This may happen to you, right? As you go up the learning curve. I was learning at that time, and I just wanted to share that with all of you, that asset allocation is key to success as far as investment execution is concerned. Once you set your investment policy right.
Yeah, I think it's demonstrating to that kind of capturing the full investing cycle, right? And
Yes.
and sometimes in that passive, you'll get it right, and you're not as you're not as worried, not worried, but you're not as focused on, like, because you really, because you can, or it's just not, it's just not part of the process there for that 401k, for instance, is, you can only touch it a couple of times a year or whatever it might be, right? And therefore you're capturing, if you're only making those changes on those big shifts, right? Even like a quad 2 to quad 1 probably wouldn't change a whole lot, right? But certainly on a quad 2 to 4 or quad 1 to 3, whatever it is, right? You're gonna definitely rotate to different asset allocations, and then let those kind of just deliver over that full cycle. And I think that's a huge thing, and something that we've talked about, Chris and I've talked about a couple of times, in terms of where you come in the cycle is really can impact certainly your initial returns and your initial kind of like assessment of the hedge process. Because if you're catching it late cycle, you're going to get, you're not necessarily going to get blown up, but you're just going to, it's just going to be frustrating for you, because you're like, well, the hedge team has made whatever 20, 30, 40% on, this exposure to energy over the last, 12 months. But here I am, and I'm down 15% out of the gate or whatever, right? And it's
Right,
like, what the heck's going on? But yeah, that's a really good component. And
I think
yeah, go ahead, Chris.
In terms of the quads as well, is they're changing all the time.
Yes. The probabilities of quads are changing, correct? So
if you make the allocation to whatever, to quad 2, but further down you've got, it says there's going to be a 1, a 3, and a 4. The problem is they're always changing. So if it changes to another quad 2 coming up, if you didn't make the original asset allocation well, if you're thinking, I screwed that up, I'm not going to get it, I'm not going to leave, I'm going to take another position or something in, because the quad's going to change in 6 weeks anyway. Well, the quad's saying it's going to change now, but as has been brought up in the last few macro shows, these numbers are always changing.
Yes.
So it could very well be like change to another quad 2, and then you're 6 weeks behind everyone else.
Yes. And for that reason, I would say that one of the best ways to tackle that situation is you create, let's say, a spreadsheet of your own. You write down all your assets, meaning, let's say, if you use ETFs to express your asset allocation, then you write down all your ETFs. You create your 4 columns, right? Quad 1, 2, 3, 4. You assign the probabilities to quad 1, 2, 3, 4. Right now for quad 1 and 3, there's almost no probability, right? We are kind of pivoting between 2 and 4, or whatever that we are, having conditional probabilities. Then you assign, is it 60-40? Is it 50-50? Is it, 20-80, whatever it is. And then accordingly, you provide the weights to those asset classes in those columns, right? So you actually may end up having some allocations of quad 2 and then some allocations of quad 4 for your final asset allocation when you are facing this kind of a quad shift. And quad shifts are big. We did see that, purely from, if we use signal, meaning if we impose the price volume volatility back onto the process, which, Keith says that it front runs the process, or rather front runs the
quads. Yep.
Yeah. Then fully being exposed to quad 4 kind of makes sense. But if we now get a rip your face off rally, right, then having that balance of quad 2 also makes sense. So the way one would think of allocation, or the way I've evolved my process to having the allocation, is, let's say if we are pivoting between 2 and 4, what are the assets good for 2? And there's possibility of 30% quad 2 and 70% quad 4, and then weigh those assets accordingly. So that way, having a decent exposure, but you're not overexposed to quad 2. So you will outperform the typical quad 2 portfolio, but you'll underperform the typical quad 4 portfolio. You land somewhere in between, right?
Mhm.
So that's an interesting thought process. I was going to put that kind of table here, but then I just ran out of time.
Yeah.
And I wanted to also touch upon over here, all this execution takes at least 30, 40 hours a week. So very important as a home gamer to understand that, you know, I have to balance my life, my work, and then this investment process. So I had to always make sure that I used to way back when, because of being a CFA, I was always so focused on security analysis. I used to spend an inordinate amount of time here. And then I just realized that this matters less.
Yeah.
You got to get your macro right. You got to get your asset allocation right. And then if you get some time, you jump into this and or use some outsource research for here. So when I say outsource research, it means things like, you know, you could use the specific sector pro sections that you have and use the full-time effort that the analysts have done. They're extremely intelligent. They use alternative data, they use regular data, and they have some interesting takes on their securities that they look at. But this always triumphs, asset allocation always triumphs security, and the macro tends to drive the asset allocation.
For sure.
And then I'll get into this portfolio construction, monitoring, rebalancing, measuring, reporting in next few slides. But I just want to touch one more thing. Keep in mind that when I tag my trades, I have multiple taxonomies of tagging. One of them is actually associated to this. For example, let's say when a few days ago in the TMS or the macro show, when Keith said signal is confirming quad 4, if I sold off a bunch of my assets, then I would tag them with asset allocation shift or quad shift as a taxonomy. So this forms one of the taxonomies for my journaling of trades. Every day I spend at least 10 minutes journaling my trades and tagging them with the right things in a tool such as TraderSync or TraderView, so that I can aggregate them and pivot them back to see, okay, these kind of decisions, what gains or losses they gave me. These kind of decisions, what gains or losses they gave me, right? So it's the taxonomy of that journaling yields reports only if I tag them this way. So this execution.
When did you start that trend?
Yeah,
I started doing that in 2019.
Okay.
And I learned a lot from that. Actually, some of the things which I mentioned on the previous slide about the execution costs and things like that, right? Those came forth to me initially when I was doing that in a very rudimentary fashion of, writing it down and things like that. So some of the obvious ones were easy, such as, changing a broker, changing a bunch of other things, or having the right tools, etc. But these things, which I just mentioned about, hey, did I get my asset allocation right? Looking back at trades after 6 months or a year, it's not possible. So just this basic hygiene of spending 5 to 10 minutes after the 4 p.m. bell goes off is extremely valuable, because you can just simply pivot that data later after, say, a week or a month. And in a weekly or monthly review, you can realize, okay, my decision-making was wrong here, was right there. So I'm going to keep honing that. So this is just a decision-making hygiene activity.
Awesome.
I love that. So you said it was TraderView, and what was that first one you said?
Yeah, TraderSync, TraderView. Yeah, both of those tools are pretty decent. I'll mention those in the tools I use slide later.
Oh, perfect, brilliant. Yeah. I actually don't. I mean, I'll do it very sporadically, which is something that Trent. This is a big takeaway for me. I mentioned last week it was, grossing up and or basically this is percentage weights, right? Chris, as you mentioned in the beginning, in terms of that was kind of a big takeaway for me last week. I think this journaling is likely, again, we're only about a third of the way through, but this is a big one that's standing out to me that I think a lot of folks should evaluate. I don't know, Chris, do you journal?
Yeah, so it was really interesting for me as well, because I've got this janky version of the quads, so where I can put in an ETF and I can get the quad background.
Yeah.
So I actually put my trades in on that, and I can see that I do a lot better in quad 4. Quad 4 isn't like I said it last week. I said it last week in terms of the dollar being non-denominated in dollars.
Mm-hmm.
So quad 4, and my trade performance goes up in quad 4.
Oh, nice.
I'm actually pretty bad in quad 2. So in that sense, just going through it, I should, if we go into some sort of crazy quad 2 again, I should just go all passive in crazy stuff and just leave it alone.
Yeah. So yeah, there you go. You know, it gives you a very interesting insight now, that because it's very non-intuitive, right?
Yeah.
So Trent, I know this kind of, I believe you know, but Chris is in the UK, right? So he's got some other, which is a lot of fun to talk about, or like have him on, because he comes at it from a very different, perspective than just a traditional kind of U.S. investor focusing with all of our U.S. tools, brokers, all that kind of stuff. He's got to think about it in a number of different components, like FX as a big one.
Got it. Great. Yeah, we definitely need Chris's chat as well on this topic.
Yeah.
So I want to highlight that, why asset allocation is key to success. This is just a quick visual graph where, something at the bottom of this on the vertical axis means worst performer. This is a best performer. And this is from 2002 to 2021. I just put it out there because getting your asset allocation right is the key to success. If you got the best international stock, but if international performed really bad in 2008, even compared to domestic, or even here, right? If international performed really bad in 2011 as compared to domestic, you're heavily exposed to that. Too bad. Your overall performance is going to be bad. And you have to get some of these asset allocations right. So this is just the equities or fixed income part. This doesn't show you the commodities or a bunch of other asset classes, which you definitely need to look at. But you'll find, these kind of charts on the web quite often. This is from the BlackRock website. But when I was putting up the slides, I felt like this was important. And my typical workflow, idea generation. So idea generation comes from, say, Hedgeye Research. There are a bunch of other research newsletters I follow too, or process. And then there's a review, which means that, okay, how much weight am I going to give to this idea? And then a position review. So position sizing is extremely important here. One of the items that I learned from position sizing standpoint over the years was position sizing is a big science. And this goes both with probabilities, just not normal probabilities, but also conditional probabilities. And position sizing, just like asset allocation, is one of the keys to success as well. To that effect, I would, in the resources slide, I mentioned about this book, which was helpful for me, called Definitive Guide to Position Sizing by Van Tharp. And that position review helps me with, do I need to go, my max allocation right now? Do I do incremental? Do I wait for the right signals for getting in? That could be technical. That could be a combination of the price, volume, volatility, as Keith suggests. It could be, for that, again, I could double click on that and, it would become a session. So,
yeah, exactly. Yeah. But, I don't know about you, Chris. I think we might have to do 2 to 4 of these things, Trend, over the next year. We'll let you keep rolling here.
Yeah. So here's how an asset allocation addition looks like, right? So let's say if this is a strategic weight, and this is not my current allocation, this is just an illustration from my investment policy statement a few years ago. I took it as an example because this way people can easily relate to it. Right?
Yeah, exactly. So everyone, this is do not go copy this.
Yes. Do not copy this. This is an illustration. So let's say this was the base asset allocation, and I wanted to add crypto on a longer term basis, not from a trading standpoint. So I studied this index called CRIX, which is the crypto index. And I did some of its statistical analysis of the returns. So I saw that it was a leptokurtic distribution, meaning it wasn't, if you see this, the peak is much higher. And then it also had a huge standard deviation, meaning it had a huge volatility in terms of its returns, right? So then I did what is called as, further analysis to find out, okay, what's the Sharpe ratio like, Sortino like, what is a VAR like, etc., the traditional analysis. And then I said, how much portion of my portfolio, this is added, what kind of impact would it create, right? And we go back to Markowitz's mean variance optimization. This is kind of 78 years old research by Harry Markowitz. And when you try to create that, I could have taken more crypto, right? Be here with say 4%, 5%, 6%. But then I'm also introducing a lot more volatility. Back then, my goal was I actually want to reduce my volatility while increasing returns, right? So the resulting portfolio characteristic I found was, this is back then, not today, that the standard deviation of the portfolio was reduced when I added 1.7% CRICS. And think of CRICS similar to S&P 500. It's market cap weighted top 20 crypto back then, right? So majority of it was Bitcoin, of course, but then there were other things too. And this result was based upon monthly rebalancing, meaning actually as crypto kept going down after that, one had to keep adding crypto every month. And lo and behold, when it started going up in a meteoric fashion, you have to keep selling it every month. So that's how you capture your alpha, right? So I want to highlight one thing here is when you decide to add an asset class to your existing asset allocation, I would urge everyone to do some some kind of analysis like this. And this can be simplified. You don't have to go through this much complication. There's a tool called Portfolio Visualizer. It's free. Just go create a login there and you can add your assets there. You can even compare your portfolio to Ray Dalio's portfolio, which is the all-weather portfolio, because they have ready-made allocations for that built in. You can even compare your portfolio to, say, Rick Ferry's asset allocation portfolio. He had written a good book on all about asset allocation. Or you can do it to many other, like Boglehead's portfolio, right, by Jack Bogle and so on and so forth. So that's a great website where you could do all this. But why I'm illustrating this here is because when Keith talks about his asset allocation, he's talking about this, right? He's saying, okay, max in a security, I would go 6. In fact, I would say if you're a US large cap growth 12, I find it hard to believe you could even go 6 in anything. And of course, if you're a pro at it like he is, he can do whatever he wants. He can say, I don't want this allocation. I'm going to have my own allocation, right?
I think as well, those levels are set, but then you can vol adjust that. So if it's XLU, the max might be 9.8.
There you go. You go.
And XLE might be 4.7.
Right. There you go. So that's one aspect. The other aspect is also that you can lever this up, right? So for instance, if this is your core and in your satellites, you have leverage available, then you can lever up your longs to say be 140, 160, and your shorts to counter it. And I'll talk about, which strategies long short makes sense in the next slide. So this is the classic core satellite, right? The core would have some sort of allocation like we discussed earlier in the previous slide. And then there's a bunch of satellites. Now, why are there 2 colors? The blue is indicating mostly capital markets, public markets traded. The this orange or amber is indicating mostly private, not publicly traded, right? So tax, this is an interesting one. I found out in 2015. You pretty much get anywhere between, so tax liens are competing with the 2-year treasury yield, and you get much superior return than 2-year in that. Also, it's asset backed, right? You are given the complete right to foreclose on the property if your lien is not satisfied. So there's that, optionality as well. You can get an entire property if you do this for hundreds or thousands of liens. US real estate, this is like one of the biggest levered play ever, which everyone plays unknowingly as well. I have some international asset, real estate asset. Merger arb, small return, but typically high alpha. But it has a lopsided risk return profile because if the merger doesn't go through, you may get a huge drawdown, which will take away all your gains. So that's where position sizing helps, or, using options can help. So on and so forth. So all these satellites I have to make certain allocations. So what that leaves me at the core is my core is not even at 60. Sometimes it's at like 50 or 55. And then all these other things have activity. And then the amount of activity I decide, because I'm a home gamer and sometimes I get busy at work, I have to determine, do I push back money from some of these strategies back to core and not worry about it for the next 3 to 6 months? Or do I just pull everything out, sit in cash because we're about to head into these uncertain times of quad 4 like Gavin did, right? And then wait for the right signal and then deploy it later. So those are some of the decision-making things I have to do along with the hedge process. I'll illustrate one mistake I used to do way back when. In 2018, there was this time, right, when we were having some quad shift. There was a little bit of confusion, and I was a bit, I used to find sometimes Keith being excessively bearish, while the market signals from some of the other sources I was getting was that, okay, we are bottoming out and we should go long. Or this could even be in March 2020, right after March 2020, his data was indicating that we have probably not bottomed out, and his tone was much more bearish. Whereas the other sides, from my other sources, I was gathering that this is the bottom. You have to go all in right now, right? So those kind of places, I couldn't fully grasp what he was exactly describing. But then I later on started learning that, how it's probabilistic and how it's conditionally probabilistic, and then how I need to do asset allocation on conditional probabilities. As I explained to you that, you write down your assets as rows, you write down all your quad 1 through 4, you assign probabilities to those, and then you use the weights according to those probabilities of the quads in order to do the analysis. So, but yeah, definitely March through May of 2020 were not a great time to be in the markets if you cannot stomach volatility. And there were massive drawdowns. People I know went in thinking they got the bottom. They further had like 30-40% drawdowns.
Yeah, exactly.
It kind of ties in. It kind of ties in with this week, though, doesn't it?
Yeah.
Well, this week he already was very clear, right? So I think he gave us a very good indication, I guess, 10th or 11th of January, when we bounced back from the previous slump. He was extremely clear. We're heading into quad 4. Yeah. And we also had that, Steiner interview, right? Josh Steiner, where Josh Steiner clearly stated quad 4 it is. The signal is almost confirming quad 4, right?
Yeah.
So
I think that was last Friday, right? Yeah.
That was so valuable.
It was.
I think as well, a couple of days before, Keith had said, I'm on the fence of whether I'm getting the macro team to start producing a quad 4 macro themes deck, right?
Yes. Yeah. In fact, he was, somebody asked him that, what are you missing here, right? And he said, he took a big pause. It was a big pause. And then he said, no, just get out of equities right now. And that was golden, that was absolutely golden.
Yeah.
So moving on quickly to the next part, this is just an illustration of how I put all this process together, right? So let's say I want to do systematic risk factor approach. And what does this mean is, as a home gamer, when I don't have time to deal with all those satellites or active management, I would pick up a risk factor approach and I would do this allocation. Now, think of this like Lego bricks, right? In your Lego pieces, you want to build, let's say, the Disney castle, right? So I would say, okay, I want to do the hedging part, or I want to do the alternative beta part, sometimes called smart beta as well. And then in risk factor selection, these are just 3 factors I could write because I didn't have a whole lot of space on this slide. And factor asset, meaning which asset class you're going to choose. Factor region, which region you're going to choose, and factor style. I have specifically circled around this because these 3 can have long short strategies as compared to the others. So carry, momentum, value, these are traditionally used by most of the hedge funds in a long short format. So which means that you can lever it up. So if you have a portfolio margin account, not just a regular recti margin account, but a portfolio margin account, you can, through diversified ways, lever up to anywhere up to 6 times. And these kind of strategies are helpful, but you have to be very thorough with how those portfolio margins are calculated. And you cannot do concentration in any security. And you need to have good pairs, which have good correlations, etc. So portfolio margin and that side of the world is to juice up returns, but you should know how to manage risk. And finally, portfolio.
Yeah, Trent, sorry, Trent, just before, so Trent shared a great video with me about a week or so ago about portfolio margin. And it's totally different. Again, it's just, you know, my background has come more from the kind of institutional side and what have you. And so it hadn't been something that I thought about on the more of a general kind of retail investor, what have you. But you know, it's a whole nother kind of conversation, which I'll share the link. It was, you know, he shared, I think, two different YouTube videos, Trent, if memory serves.
Yes.
And it was really awesome, and something that I think, you know, everybody needs to look into if it's applicable to you. But as Trent said, it definitely brings in an extra layer that you have to be very cognizant about.
I think just quickly, there's a guy, he's a vol trader I think he's based in London. I think his name is Harry Krishnan. He's been a lot on one of the trend following podcasts, and he got me onto this where I haven't read his book, and one of his books has just come out. But just like on this, he talks a lot about even if you're not a trend follower, build a trend following model just so you know how it works and kind of have it running in the background so you can understand where positioning is for that style. And then like in these carry trades and momentum trades, even if you're not a momentum trader, build some kind of momentum model to have it running so you can understand where people are, you know, out over their skis on all these different positions and what, not just an asset, not just, you know, everyone's super long of XLE. I've said XLE a lot this time, but
you know, it's clearly on your brain.
Even just the asset, you can say, right, well, like the value traders are like either really bullish or really bearish, or depending on their positioning. It's just another thing. It's another thing to add in. Where we spend a lot of time just looking at assets and, you know, how they've performed in the last 1 month or 3 months. But you then want to take a step to build up to the next part is look at it by not assets, but by strategies.
That's a great idea. I think, there are indices too to follow that. HFR.com is a good website.
Oh yeah.
Yeah, you can follow how some of these strategies are returning on a monthly basis, but it's not doing justice, as you said. If you have your own models, you can see it on a daily basis rather than waiting for HFR to come out on a monthly basis. So totally agreed. Yeah. And then finally, let's say when I decide that I want to go in this, the portfolio construction, this is a key part, may do weighting very differently, right? So I showed you earlier when I was adding that crypto asset class, I did what is called as MVO based risk management, which is mean variance optimization, right? So, but it could sometimes be a different model, like a Black Litterman. This is commonly used by robo-advisors in order to create their robo-advisory portfolios based upon your preference of risk.
I think that's what Betterment is based off of, right?
Yeah. Betterment uses that. Absolutely right. Yeah. And then fixed weights, and this is actually mentioned in one of the CFA literature as a very model. So fixed weights, market weights, you can just use your SPY or the spider related ETFs, right? So XLE, XLU, these are all market weight based, SPY, etc. Fixed weights means equi-weighted, and there are different set of ETFs for that. They all start with the letter R, as in Romeo. They are fairly useful as well if you're using some specific analytics. But if you don't want to do active management, just, you can stick to this or this and choose your weights. So this is basically for helping you choose your weights. And you can do a combination of anything. So for instance, you can do equities, EMEA, traditional beta, fixed weights, right? So, and you can find tickers for that, and you should have that kind of compendium ready usually, so that you can decide that, okay, right now is not the time for next couple of months. I'm going to be busy for health reason or for work reason or whatever. Just do this risk selection, set it off, and off you go, right? And on a pure risk management basis, you might want to have a volatility targeting mechanism, which means that if VIX rises to 27, like it did on Friday, reduce my exposure, right?
Mm-hmm.
Especially when in the hedge research, we got a call that it's a trending volatility. It's not a non-trending volatility, which is very different. And and this is where I use hedge research a lot, that, for risk factor selection and also sometimes for construction. As I mentioned, I use some of those inputs. So I wanted to share this because I know many times in TMS, when he talks about some of these things, there's a certain degree of assumption. Also, he asked to go to Hedge University, but in Hedge University, I've not seen this kind of material yet. There's other good material, great material, in fact, which I've not seen anywhere else. But I use the research this way. I know people use it differently. I've also mentioned some couple of other things, which is CPPI and OBPI. This is nothing but the PI stands for portfolio insurance. So it could be options-based portfolio insurance. There's a ready-made mutual fund, which is used by JP Morgan for extremely high net worth individual, because its entry point is 1 million. It's JHEQX. That's a standard example of your OBPI, because what they do is they give you equity-like returns, but they're protecting your downside. So if you compare SPY with JHEQX recently, it would have given you less drawdown compared to the SPY. And they're a notable player in quarterly options market.
Yeah.
Because they run a $20 billion asset under management. When they come in the SPX market for quarterly expiries, they are the biggest open interest out there. So that's why, there's few Twitter folks.
Yeah. Is that why? Is that because they have that fund that's I've seen them. I just never really went that extra level, I guess, or extra mile to inquire why they had such a large, you see them all over the place in terms of the options expirations, and especially on a quarterly basis, them being the biggest player, but I just didn't really equate the one with the other. So that's interesting.
Yeah. So moving on quickly, this is another example that, let's say if I had to do enhanced beta, which was one of the strategies here, enhanced beta, right? And if I want to set it off that, let's say quad 4 is going to have much more XLU requirement. So within that percentage of the utilities exposure that I want, I may, instead of going with XLU, choose the ones which are in green here. So just to orient everyone, what this is a relative rotation graph, and the vertical axis is showing the relative strength momentum. So this is purely a momentum, that your relative strength compared to XLU benchmark is rising or falling, right? Above 100 is rising, and below 100 is, it could be rising, but it is falling. So the direction, and all these dots are showing you how many days back or how many weeks back, depending upon what you choose here on the daily or weekly. So what this means is, typically the expectation of a journey of a stock in relative to its benchmark is expected to go in a clockwise fashion. It is possible sometimes, if it gets, struck with a fraud or like Evergrande or something, it might just stay here in the lagging section forever compared to benchmark. But if that is not the case, or even the Bill Wong tragedy that happened, right, with
like Viacom, stuff like that.
Exactly. Those things were in this red for the longest amount of time, both on daily and weekly. So the way I use this is, I would typically pick up, let's say if I know that XLU is coming up from a quad 4 perspective, I need to have more XLU exposure. I would start with the weekly, not with the daily. And I have a slide to show that. I would see which ones are doing better, which ones are in this weakening and lagging. I would kind of skip the weakening and lagging and take the rest in the same proportion. So this is called enhanced beta, because instead of directly buying XLU, I'm buying a basket of these with the same weights that they have, but I'm skipping the ones which are the laggards. Now, it can blow up in my face. It can blow up in my face because sometimes the laggards may have like a huge rally. So one has to look at the weights as well. But this is just one strategy I'm describing of how to further juice up your sectoral allocation. Of course, if you don't have time, do not do this. But if you can set up your orders in an automated fashion with right stop losses, with trailing stop losses, etc., then something worth thinking about, right? It can juice up your return.
It's interesting I do this, but not to this level of degree. Like for instance, Verizon, I highlighted this the other day, Verizon and AT&T, right? They're two stronger components inside of XLC, and XLC is typically an outperformer in quad 4, or at least it's on the cusp. But right now, it's got 40% allocation to Facebook and Google, and I do not want that exposure, right? So you can significantly outperform the comms by having Verizon and AT&T in your underlying portfolio, while kind of limiting your overall beta, but enhancing the beta at the same time, right? Or sorry, limiting the volatility but enhancing the beta. So it's interesting. I hadn't seen it like this, Trent. So man,
and you can do this for any ETF, right? So for example, let's say when everyone was shorting ARKK, yes, it's easy to short ARKK, but if you want to really get the worst ones and you want to really drive that train, then you catch the ones who are in ARKK in the weakening and lagging and short further, because that will probably get you the most juice. But it all depends. So this is simply what happened in the past, right? If you go to stock charts, there's also an animate button. You can see that does this
how it evolves, right?
And does this group actually follow that clockwise path? Because I've seen certain groups in which they'll go to green, they'll go to yellow, go back to green again. Right? So you don't want to be short something in weakening without a stop loss, and it goes back to green again on you.
Right. Yeah.
It's funny looking at this from the quad perspective. Going back and looking at the quads,
it actually works. So
in the summer when so the quad signal on the charts was a quad 4, and everyone was like, well, why is that big scary quad 4's in there? I think it was in Q3. But having known, Keith kept saying, no, I'm front running my own. I know the system and I'm front running it. And when you say there, the longer you spend looking at these things, is in the back test, there's never been a direct transition from quad 2 to quad 4.
I see.
It's the only transition that's never happened. So how much of that was Keith was front running himself by saying, look, okay, there's still more data to come through. But as soon as you know that there's never been a direct transition from one to the other, then it heightens your, it's 100%, at least in the past.
Right.
At least in the past, it's 100% weighted.
The probability was, it was literally a 0 that would happen.
Because inflation lags, right?
Right.
Yeah. Inflation lags. You're right. Absolutely.
So it's always going to transition into, well, not always, but it's so like when you say we're looking at the individual components of all these things, if you spend time actually looking at them, you can pick out the ones that are, you start to know what they do.
Yes. That is true. And that's where the security selection kind of gets slightly simplified with something like this. And the reason I brought this up is not for showing this is how I do my security selection, but this forms a initial quick, our human brains are extremely geared towards watching visual brain and capturing things quickly as compared to trying to read them or just interpreting in our brains or whatever.
Trying to find snakes on a screen.
That's right. It's great. Trent, I'll have to send you that. Chris shared a paper with me, and it literally goes back to when we were first created, or however you want to think of it. But we wanted to avoid the snakes in the grass, and it's fascinating.
Wow.
Anyway, yeah.
So quickly moving
again, Trent, I'm not. We don't need to harp on it, but it is definitely a great visualization.
So this was
something that, again, it's like I do, and I've been doing kind of intuitively, right? Like looking under the hood, and I'm trying to understand and find the quote unquote winners, or the ones with the best signal strengths. And this is a great way of just
looking at signal.
Yeah, so this is a great way of like
this is signal. Yeah, this
right.
is a signal, because each of these points are your relative strength points, both momentum terms and ratio terms.
Right.
In fact, I've seen many times there has been a pretty decent overlap between some of the signals that we get from Hedgeye versus what I've seen in the quadrant if you choose the benchmark correctly. What I mean by that is your benchmark, if chosen something different, let's say if I put SPY here while keeping Utes, I may get a completely different graph. So
absolutely.
Yeah, because this is all relative, right? So relative strength wise, it matters.
Yeah.
So next point I want to capture is performance attribution. So yes, I did execution, right? I told you form the asset allocation, form security assessment. Then I'm going to get into the performance attribution, because at the end of the day, this is what matters, right? I'm doing so much effort, but was my country selection right? Was my sector selection right? Was my security selection right? And if my security selection sucks, like I told you in the past, then I'm better off just focusing on country and sector, right? This is, again, illustrative. This is not my actual performance. This is excess return. The way you do it is you go to MSCI website. They have free end of data research. I put a link of that in the resources. You take that down, right? And you try to compare it with what judgment or decisions you made in your portfolio, and try to see how much excess return you were generating. So this also gives you a certain thought process that, am I good at sector selection or am I good at security selection, those kind of things. And then how much is attributed for what, and what can I do to improve this, or do I want to improve this? Because the amount of effort spent in security selection is usually huge, right? Hedgeye gives us these two very well, right? The quads are global from the country wise. And then sector wise, your quads drive somewhat of the sector piece, but they may differ from country to country. Security wise, this is a lot of effort. This is where I keep thinking that, full-time investor can do this much more than I can. So I usually would just stop here. If I'm spending 35 hours a week, I would get into this too much, and then try to let it run. On the right-hand side, what you see is a seminal work which was done by Brinson B. Bauer, and there was one more author, I forgot that author's name. What this shows is that how do you compute whether your timing gave you excess returns, whether your selection gave you excess returns, and whether there was other unexplained results, right? So your selection being actual and passive, and when we say passive, just choose ETFs, right? Like what we saw with the earlier chart where we were saying, okay, just choose SPY and some international one like EFE index or something. And then your actual in terms of your timing, that, okay, I'm going to be really good at timing in all this. Are you truly driving results or not? This kind of feedback for yourself is valuable, because if I find that I'm not great at country selection, I need to do something to learn about that. And I was not good at that, in 2013, 14, when I initially got exposed to Hedgeye, and then I started learning a lot. I started learning much more about the macros. And that's where, when Keith shares the features that drive some of those things, they're valuable, because then that tells me, okay, I never thought of that factor.
Right.
So, Japan tools, right?
And that comes into the time part of it. Is let's say there's 50 investable countries and there's 5,000 securities.
Yeah.
It's like, which one am I going to get better? Which one am I going to get better at quicker? The 50 or the 5,000?
Exactly.
So
it's great. I mean, because this again, a real KBA is a good example of my portfolio, right? So I time, it's obviously selecting also, say something like a PDD or something like that, right? So, I moved over to KBA, more of a passive in sort of, mid-December, and added PDD kind of in sort of early January. So it's like one of those things where so I can review that from both a sort of more passive ETF standpoint. And right now those returns are relatively flat from the KBA, but then in Pinduoduo, it's been outsized. It's up 15, 20% or whatever. So it's interesting. So this is very, 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 very helpful.
Yeah. So now if folks think of active management, I would say these are the things that help me as a home gamer. Automating through scanning. So there could be daily scans, there could be weekly scans, depending upon which satellite needs what feeding, right? Or how much cash is in with satellite. setting alerts to the scan results. So for my personal self, I've created some scans on which if specific scans have seriously high probability outcomes, I've set up in such a way that I get an SMS when that happens, because some of these opportunities are so short-lived that they are there and they're just gone, and I might be busy at work in back-to-back meetings. So I've set some of these alerts both on the computer, meaning on the actual software, but also such that I would get SMS on that, right? These two things in automation, very important from an idea generation perspective. Also have an idea generation funnel. So, we always hear Kate about bench. That bench is nothing but the idea generation funnel in the process that he has. And then he just keeps it ready that, when the moment is right, when the factors are right, we'll just attack it that way. Also have an idea ranking mechanism. So what I mean by that is I have these scans set up in, say, around 5 different places, because each platform has their own pros and cons. But I know that one platform has lower probabilities compared to the other one. So I have an idea ranking mechanism. And also within the strategies, there's idea ranking, right? So those aspects are important. You will develop this in your process over a period of time, also based upon your own comfort level, meaning I might be okay with buying a dip on the, say, when 9 EMA hits a certain level and the implied wall is higher, I might be able to take that. But from a standpoint of quantity or sizing, I might be sizing it too small, or in order to just make sure I get something, and then have a tight stop loss or something. So, but for someone else, it might be different. They might be much more comfortable with something like a 50 moving average, or it may not be even moving average. It could be something else completely. So whatever your scanning criteria are, and this is where I use the combination of price, volume, and volatility quite a bit in order to come up with certain interesting results. All of them are probabilistic. None of the scans are definitive, right? They're not 100% outcome oriented, but they tend
to give folks a little example. Trent shot me Trent shot me a note, but I think it was last Friday, right? Trent, I believe I have to look at the tapes, but on Casper, right? So Casper's getting bought out for $6.90 a share. This is inside of his merger arb satellite, and he shot me a note. He was like, take a look at the price action here. He wasn't telling me to go buy it or anything, but then I did my own due diligence. So I was like, hold on a second, this price action doesn't make any sense, right? And there's basically a basket of kind of the machine was selling down a basket of
mattress stocks,
mattress stocks, like Sleep Number and Tempur-Pedic and stuff like that.
Right.
And Casper was just getting caught in the middle of it. And a week later, in a down market where S&P, the NASDAQ, everybody was getting kind of crushed. Casper, I ended up kind of buying some of the underlying last week on Friday and Monday. Yeah. And it returned 16% for me in a matter of like 5 days, right? And
that's a great example.
It's a great example of sort of like getting some alpha and having these screeners, and in my case, having new buddies like trendwhizo hit me up.
So that's a great example. So those would be some of the alerts. And in that case, it was an absolute alert. There was no scan. It was just an absolute alert that, hey, this thing has gone like 20% below the deal price, right? So that's a great example. So similar to that, there could be other scans. They could be technical. They could be fundamental, or whichever ones you want, and then just set up alerts so that when you get them, you need to, of course, have an evaluation, and then you can jump on it later. But before that, in order for you to set those, you need to do backtesting on them. Again, backtesting results are not necessarily something which will be replicated. So one has to have regime filters on during backtesting. What do I mean by regime filters? Certain price action works well when VIX is below 25. But when VIX is about 25, if you try running head on into the storm, you might get a serious drawdown and a big loss, which you may not be able to take. So you may want to have certain regime filters on, be it Wix, be it some other ones.
Coming into January, that was a big thing that I said. You're not going to make your year in January, but you could really screw it up by getting this first part wrong.
Yeah, that is true. That is true. In fact, there are some of my positions in which, because Friday the VIX trended up about 27, I'm now kind of reconsidering them as I go through the weekend analysis and my weekend routine. That do I need those in place? Do I cut my losses in them? Because VIX being about 27 and non-trending, there's only one thing that would stop me from doing that, is the potential probability that the gamma exposure was so low that from there it would just probably go up. But we'll talk about that later too. So being flow aware is important. For this, I use etfdb.com. It just tells me which securities and which ETFs, and if those ETFs are having a lot of exits or fund flows, then I would they can become like good short candidates. I'd seen that during the March 2020 crash, that when there was massive fund exiting from IWM or IWC, the weakest of the stocks in that, and there were almost 200 of them in IWM, you could just short any one of them blindly and make like outsized returns, like 30-40% on your positions. It's just bizarre. So being flow aware is important.
It kind of happened Thursday to Friday. I put on, again, I don't need to get into stuff that I did, but pins is a good example, right? I put on kind of late Thursday, and it was down, I think 9. I made 9% on it, and wow. I closed it out on Friday, but it was kind of one of those things. Where it was like, it was a low end of the range, and so it was like, typically in the past I would not have shorted there. I would have waited for like a bounce, but it just seemed like if it kept dropping, it was really going to move lower. And Dick's Sporting Goods is another example, which was highlighted in the RTA, right? It was definitely more at the top end of the range, but once it started to move lower, some of these weaker, components inside the retail and other areas, you could basically just short anything, last 48 hours and you would have made money.
Yeah. And what I do is I just go to ETFDB for the holdings of any specific one. So let's say be it ARKK or be it ITV or those kind of ones. Base them on a specific tool where I can see if I want to list them based upon their trend strength, but on the downside, and which ones are closer to their 52-week lows. Wait for that entire basket to bounce back up slightly, and then initiate shorts on that basket. And it becomes like, I have some names for some of those scans, like, stinker shorts, or jailbreak is for actually the other way around. We're getting into an oversold position, right? Some of these things which will start bouncing back will bounce back like 15, 20, 30% within just 3 days. So that jailbreak scan, I'm waiting for a confirmation for a decent bounce. But before that, I won't do that, because these are all going to be really bad stocks fundamentally and technically, but the jailbreak stocks are simply a turnaround. So all those usually one should keep ready, as just like how Chris said, that in the trend following, you want to have some of these strategies running and in the background, and I let them keep running, and I just keep noting their performance, and at the right time just pick up a basket and just shoot it through for that. Also, writing a thesis helps,
but size it appropriately, right?
Yes, you have to size it up. You're right. So that's the next point, right? Writing a thesis, that how do you size it relative to portfolio? It could be 25 basis points. It could be 50 basis points. It could be 100 basis points. And this is the part where most of home gamers get it wrong, right? I used to get it wrong. For instance, in 2015 or 16, I found 3 ideas, and I used to not have such a big idea generation funnel back then. So I felt like, oh, these are great ideas. I want to bet 5% on each one of them. Mm-hmm. So that was a very poor decision. I learned it the hard way. I lost money.
And I mean, again, pins for me, it was 50 basis points, right? So it's like, it was not like, if it moved against me, I could quickly, cover it. Basically I had like a stop loss at like 2%, right? So it's like, okay, if it moves against me, it's not going to be the end of the world. Luckily, it moved the way that I thought. But yes, it's exactly. I mean, Chris, it's spot on, and Trent, yeah, absolutely.
So money management, stop loss, all these things are important. And developing analytics for overall portfolio risk contribution, absolutely important. So you can use Portfolio Visualizer for this if you're dealing with it at a fund level, if you're dealing it at a security level. But these are things which I learned for active management over the last few years. So having said that, journaling. Now, you remember we spoke about journaling, and this is almost like an essential cognitive behavioral therapy. Many times in prop trades, so I have asked a bunch of prop trading firms like SMB Capital in New York, or there's a whole bunch who are set up globally. They told me that their failure rate, meaning of traders who actually go past the first month, is 95%. So think about it. Active management failure rate in prop trading is 95%, which means that there is something about human behavior which gets stuff wrong, right? And to fix that behavioral aspect, what I learned was, just like any other behavioral aspect, cognitive behavioral therapy is absolutely important. And what cognitive behavioral therapy does is, it makes you write or journal certain things. That, what did I think about? Was that thought helpful or not helpful? What was it based on data, or was it based on feelings? What was I feeling at that time, right? Why was I uncomfortable at that time? How did I drive this decision? Those kind of things. So similar to that, journaling your trades is almost like a CBT for fixing your investment decisions. And the best way to do that is, before you enter the trade, you fill out a decision-making form quickly. It could be, you could fill out just a few words initially, and then later on fill that out later, because you might want to trade it quickly. But you need to fill out those at least few boxes, that how much am I sizing, how much is my stop loss, etc., almost to a point where it becomes a habit. And then after the trades are done, you tag them. That one, which satellite was it for, right? So the tagging could be using a strategy taxonomy. It could be using a risk factors taxonomy. It could be using a performance attribution, like was it a country selection, sector selection, etc. Because later on, because in a year I end up having like anywhere between 6,000 to 10,000 trades. So at the end of it, when you pivot it, you'd get all your metrics that, okay, this works for me, this doesn't, this gave me gains, I want to fix that, etc. So that analytics is not possible unless you journal or unless you tag your trades. So absolutely important. It has completely done a 180 on my performance between 2014 to 2016. And this is one habit which made me from being an underperforming investor to a fairly outperforming investor for my benchmarks. So
and none of this has to do with what you're buying and selling, right?
There you go.
Everyone concentrates on that part. Everyone concentrates on figuring out, what's the best entry or exit price, or this or that or whatever. And it's just forcing yourself to write it down will save you from making the bad trades. And if you can cut the bad trades, or reading what you wrote in a trade that's going against you, and you're like, right, it's not meeting that criteria, so I need to close it.
Yes.
It doesn't matter what somebody's talking about on Twitter, or someone's brought it up on CNBC or whatever. The trade isn't doing what I said it would do when I clicked the button. So close it.
A perfect example of this was for me. First, again, I apologize, I keep going to myself, but when I shorted oil 2 weeks ago, OVX was flirting north of 41, right? And it took basically a cup of coffee up there in the afternoon. I think it was like a Wednesday afternoon. And then the next 2 days, it just came right back down. And so if I journaled that, and I was like, okay, I was expecting, I added to my, oil position, my short, and then it completely reversed what it would have done. This is like, again, I'm going back in the playbooks, and I know now I should have just stuck to my, rather than waiting it out. And I think, I will eventually get paid, but it's been 2 weeks of an asset or an exposure that has been going against me, and I could have avoided, that drawdown or that exposure, and just covered and reevaluated it when, the underlying metrics, which is basically, increasing price with increasing volatility, which is what we kind of got Friday after Friday, of OVX shooting, moving higher with oil prices moving higher. I could have come back and reevaluated and said, okay, let's try this again, right? And like see if we can get it right.
It's doing it enough and having the humility as well to, you could have seen that journal entry or whatever it was and then gone, right, I'm going to close it, and it could have gone right. But it's having the humility to say, like, I had these are my decision processes for opening the trade, and now it's not met them, so I'm closing them. And it's having the right, okay, like, I made the right decisions based on what I've set down. And then going back through all of this, and like what Trent's saying is, at the end of every year or at the end of every quarter or whatever, you go back and you have a look and you can break all these trades down and you can say, right, well, maybe I need to change one of these criteria.
100%.
So then,
reflect on these decision analytics weekly, if possible. I should have written if possible, because there are weekends when, my wife would be like, you are stuck to the markets. So I have to make sure that, there's balance in life as well. So I would then maybe do it some other weekend or something, but usually these things happen only on weekends. Or maybe, if she's busy with some other things, then that's when I'll just sneak in some of these things. But this is not possible unless you tag your trade. So tag your trade. That's like a data hygiene you have to do in order to make sure that you would get this. And then it becomes a nice feedback loop to your process. So
definitely,
without data, you cannot, if you can't measure, you can't manage. So, and I'll be honest, if someone doesn't have time to do a bunch of these things, just outsource it to a good manager, right? Then you can maximize your human capital. It might be possible that in your day job, there's much more potential that you are leaving untapped, where you might get much more return. So you might want to do that. For instance, I have a cousin, 3 years ago, he was trading. He lost a lot of money even when the markets were going up, because he was doing some premium, he was writing options for premium to get some consistent income. Someone told him that strategy from Tasty Trade or something. He started doing that. He lost a lot of money. He gave that up. He gave up his job. He started his own startup. He made a 8-figure exit. So I would highly recommend also evaluate your human capital potential as compared to your investment potential, and then determine if there's a room for that as well. And then you can outsource all of this to someone else.
And it's a great point. And there's a lot of hedge eye, professional folks that leverage hedge eye. So like, if you like the hedge eye way and the way that they approach it, you can definitely find, you can do your due diligence to find those that do it and that take that approach to the markets and the investment.
Definitely. And these are some of the tools I use. St. Louis Fred is a great website. I put this in the resources slide too. Basically, it gives you a lot of macroeconomic data. You can have it as a Excel plugin, just like the Bloomberg plugin, right, to pull the data and quickly create your charts, or put in your research process or whatever. Newsletters, or hedge eye, be it the macro show, be it the sector pro, be it the macro pro, etc. Idea generation, I use Sentio. It's a great tool for me as a substitute for Bloomberg. Bloomberg is very expensive, and Sentio serves my purpose as far as going through SEC filings is concerned, or writing certain keywords in order to find common themes across transcripts or whatever, or news feeds. I have some proprietary dashboards and data pipelines based on various data feeds I get. That also gives me some idea generation. In options, I use LiveVol, ORATs, iVolatility, and there's a TradeStation API. This is not as useful, the API, but options data, to get it in API format, is extremely expensive. So I end up using this to develop some of my own scans. But last year, actually, funnily enough, from my journal, I found that my option strategy satellite generated way more than, 6 times more than my expected annual return. So this year I've increased with allocation from 5% to 8%. But again, it depends on how active I am, right? What is my bandwidth availability? So it shouldn't happen that I increase the allocation to 8% for the option satellite, and I end up not being able to actively manage it and lose a lot of money. So
right.
So that's important. And then ETFDB is for just finding all the holdings and what ETFs are out there, et cetera, or fund flows and those kind of things. This is a free resource, forexfactory.com, for macro events calendar across the globe. Many Forex traders use it. Chris, you might have a better one. If so, definitely share with us. Portfolio construction, many times portfolio visualizer, Excel, the good old mighty Excel. And for execution, Fidelity, they have an Active Trader Pro software, not as good as TradeStation, but this is my core. These are my satellites. CQG and Rhythmic are used by prop traders quite a bit. I like some of the features in them. So for a few satellites, which are algorithmically driven or much more automatic driven, I use that as well.
Interesting. Okay.
Yeah, journaling, and finally research papers. If you
Right.
go to Google Scholar, you'll find a lot of research papers, which are great. These are all the resources I spoke about earlier. St. Louis Fred, MSCI index data. This is free. You wouldn't believe it. This is free. You can do a lot of modeling and a lot of testing of quad data using this data. The other day, I saw someone in the arena create a Google Collaboratory. It's pretty awesome. That guy did a great job. And I told him, he could probably try to use some other data sources as well. He was using Yahoo Finance and one more other data source, but this would be a great data source too. Research papers.
Chris, is that you? Or was that somebody else?
No, it's another guy.
Okay.
Danilo. It's
Yeah, that's it.
Yeah,
cool.
Yeah, it's really cool stuff. We actually got. I was trying to say to use a slightly different calculation, but he didn't really like that. So.
Guide to gamma exposure. This guide to gamma exposure is pretty interesting from Squeeze Metrics. It's free. Check it out. Someone asked me recently that, hey, should I buy their service? I wouldn't. It's just a good thing to see. It's not necessarily something that gives you an immediate edge, but especially on, times like Friday when you had the least gamma exposure or the most negative in like sort of historic in many ways. This kind of guide is important to understand why these kind of weaknesses happen in the OPEX. If you remember from our last weekly, not the one where Mike attended, but the one before, I mentioned to you, Rob, that, we need to focus on OPEX because we're going to get weakness. And this was the exact weakness I was anticipating to this degree as well.
Yeah.
But this guide would help you explain why that happens. There's also a great thread by a person whose Twitter handle is Perfiliu. He has written about how the Vana and charm flows affect the overall markets and the underlying during the OPEX week. Typically after the OPEX week, hopefully things should try to normalize, but I still see that probably our Monday morning might be weaker before we create an absolute panic bottom. So let's see.
Yeah.
To that effect, outlook, this is the GEX, which is a gamma exposure that I was talking about. The orange line, we have hit a bottom, which was worse than the December one, or even September 2021, and the March 2021 one. So it is kind of historic because this level of negative gamma was not even there during March 2020. So it was a very interesting OPEX close.
So I'm doing, I've had 3 attempts at trying to do a video on this, and
oh wow,
it keeps getting to, because there's so many aspects that feed into it.
Yes.
So for all of 2020, so for all of 2021, there's this gamma exposure format, and he uses 30-day forward returns. So so his analysis is any gamma exposure less than 0 gives a positive return, and it does. But a bit like when I share my quad charts, it's that it changes a lot over time. So if you look at the entire curve going from minus whatever, I'll have to change it now, but going from minus 5 billion of gamma to plus 25, the entire curve is positive, and that's what we've had for 2021, right? Every dip's been bought. The market's constantly gone higher. But if you go back and you look at the entire data going from 2011 to now, there are periods, and only if you split it down into these separate parts and you actually have a look, and it's like, right, well, 2021 is a massive outlier, not just in these values that are on the chart here. Like the one from last week has been the lowest negative number, so that's an outlier. But 2021 has been a complete outlier.
Correct. Yeah.
For the rest of the data.
That's true.
And when I talk about my charts, like of looking at the look back window and how if a 3-month high is 3 months ago, then mechanically the price is going to start coming down. The high is going to get lower. So if the price doesn't move, and that's the same, and that's what I'm trying to build into other things. Is with this, we've had a high in terms of the total return for the S&P 500. So now moving forward, the constant crush of vol is going to be falling out of the market.
Yeah, possible. Yeah. So basically you're saying we are topping out, right? So we are topping out on the underlying, which is S&P 500. So we may get more episodes of lower and lower numbers on this negative gamma number.
Yeah, because if you change your look back, so if you're on a 2-year look back, obviously like the March 2020 in terms of vol is going to fall out of the look back soon, right?
Yeah. That's right. Yeah.
So any spike in vol now is going to look
trending.
Is going to look higher because the big 80 vol is going to fall out. It's not going to be the 80 vol is going to fall over this side of the chart, and now you're only going to have the 50s and the 40s and the 30s.
Right.
So any spike in vol is going to look higher because that one's gone.
Yeah. No, I agree with that analysis. From a trend following perspective, that makes sense. Yeah. Our look back has reset, meaning that window has moved forward. Okay.
Yeah.
Great. So that's one of my outlooks. Does that mean we're going to continue to have correction? Maybe in immediate short term, we might form a definitive bottom in next couple of days, but we still have a lot of headwinds, right? This is again the RRG from asset allocation standpoint. So showing the bonds getting into the strong performance category. Keep in mind the benchmark here is not other bonds, it's VBINX. This is a Vanguard 60/40 portfolio. What this might actually also indicate is that the target dated funds, right, from the large providers to most of the 401k plans or otherwise, they would have S&P 500 at lesser than their targeted percentage, and they might jump in for a monthly rebalance in order to achieve this. If they're doing monthly rebalance, if they're doing quarterly, they might not jump in, and we might have more outperformance of bonds and underperformance of S&P 500. So depending upon the rebalance frequency, we might have that flow coming in order to update the selling, but definitely a very weak time for from an asset perspective. And here you are with commodities, right? GSG and DJP completely, up into the right. We see this in crude, we see this in cotton, we see this in a bunch of other commodities. But as Keith is saying, they would probably peak out as well if you're hitting quad 4, which makes sense. So I would be looking out for these to head lower in terms of momentum first, and then head to the left in terms of the relative strength ratio before I start shorting them. Because right now they're just super strong. It would be insane to short them here. US factor positioning. Value is improving.
I could have used that lesson about 3 weeks ago.
Value and growth. So growth has been punished relative to value for the last 7 weeks. This is a weekly one, so you have like 7. So how do I incorporate this along with signaling? Signaling is dependent on day-on-day return, week-on-week return, month-on-month return, right? This 3-month and 4-week and all those things. So that's how I end up using this as well. It's sort of a proxy, not a perfect proxy, but sort of a proxy for those changes. Of course, this doesn't factor in volatility or volume, but at least that aspect, it clearly shows that value for the last 7 weeks has been outperforming. Part of it is also, large asset, large assets under influence, I call it, not management, such as Morgan Stanley, right? They had that call from November by Mike Wilson that, hey, within your portfolio, he's not asking to reduce equities. He's just saying tighten up, meaning get out of high P, get into low P, get into more defensives, etc. Think about it. They have 4 trillion asset under influence because of the E-Trade acquisition. So those kind of US strategist comments also tends to drive some of these flows, which is we are clearly evidencing. I'm not attributing any of this to his call because, you know, up until December, he wasn't as right, but then starting December now, he looks kind of smart. But regardless, connecting this back to the quad 4 call, I think in quad 4, even value goes down, if I'm not mistaken. So we'll have to be cautious with overall equity exposure in general. And this is how I look at it side by side. So the left side is in the daily fashion, right is the weekly. And what you're seeing at is the international positioning. So you'll notice that RTSI, which is Russia, crash, right? Complete crash for the last 9 weeks. And then Bovespa making kind of new highs. So quick, immediate data visualization, look at it. Kospi is improving, right? Korea, but I know that Korea has been a bit of a short. I usually wait for these things to come over here in the weekly and then play around on the daily if I have to. Sector ETFs, we know this, you know, youths and the consumer, staples outperforming compared to XLC, XLF. We're seeing XLY and XLK doing this kind of a weakening dance in the weekly. We'll see how this turns out. And sometimes I look at equal weighted ETFs as well, instead of just looking at market weighted, because they may offer you some alpha opportunities. It's interesting to see here the same youths and the staples, you know, getting into great leading quadrant for weeklies. So we would probably have some youths and staples outperformance going forward here, along with real estate.
And that kind of comes into the, you know, if you put a lot of weight behind the gamma exposure type levels, it's the trade-off of, if we're going to get some sort of relief here over the next week or two, do you take the risk of buying the crappiest stuff, which will bounce the most?
Yes.
Or are you strict with yourself and use this opportunity to buy, you know, to build your utes and staples?
That's a great point.
Positions, right? So it's that, like this is the bit that got me into that made me shift so much into crypto. It's like, well, if everything's going to go up, I may as well buy the thing like the most shit. Like crypto for me was like, I had no idea what any of these coins did. Absolutely nothing, like no idea whatsoever. I didn't follow anyone. I didn't read anything. I had zero idea of what any of these things were. And it was great for me because I could just look at the numbers.
Right.
I just looked at the numbers, and then so that's this. It's like, it's this trade-off. It's okay, we think there may be a bit of a relief rally here. So what do you do? Do you, like, in your way, like, are you building your core positions while also looking at some of these other things of like some piece of crap is going to bounce more, but you're sizing it much smaller and using, you know, in your satellites, looking at it that way?
Yeah, that's true. So you're absolutely right. I actually do plan to do that. So I have a scan called jailbreak scan, and I put it in use on oversold times like these, like Friday, but it needs a confirmation, which means that you need a confirmation for some of the oversold stuff to make that first higher low on an hourly or on a daily kind of chart in order to jump in, because at that time then you start getting like 10-15% return on that basket, and that's at like won't be more than 8% max or 6% max. So but you would buy like 10-15 names in that crappiest stuff and it bounces like crazy. get out of it in 2-3 days.
Yeah,
And
just in terms, sorry, just if the way that you're developing your look back, this feeds into the journaling and your decision process. If you, so the type of drawdown charts that I use, that's 20 trading days, right? So if I make a decision, if something has drawn down 7% and it's bounced X amount of times at that level, my look back period is 20 days. So that's in my journal. So if once the trade's longer than 20 days, I'm out, because that's my window, right?
Right.
So in terms of this, if you've got anything and you're sorting your data somehow using 10 days, well, that needs to be in your journal, because once you're outside of 10 days, whatever data you're using and whatever analysis you're using is stale, because that's not the time period that you were looking at.
Yeah, like if we get an oversold tomorrow and you pull the trigger on something, you gotta be out by next Friday on a 10-day look back. Or
if that's what your time frame is, and that's you're gonna know that if you wrote it down and then have some sort of trigger, not just on the price, not just on a price chart, but just to say, right, I opened this trade 5 trading days ago and I need to be out in the next 2 days because my look back in 7 days or whatever it is.
Whatever it is. Yep. Makes perfect sense.
Awesome. So then, having said that, this is a crypto stuff, everything crapped out, and this is weekly. So when I say benchmark one means USD. So this is with the USD. Everything crapped out, right? This is week over week. Signal bad, really bad. Like you said, Chris, from November onwards, kind of pivoted, just went kind of belly up. And that was my last slide. So, this was a great conversation. I loved it.
Yeah, it's been wonderful. Thank you.
Yeah, I look forward, Rob and Chris, to your sessions, as well as to other sessions of other Hedge Nation, process builders. It's always a learning process.
Yeah, for sure. We've only done 2. Well, we've done the kind of starter one, and now obviously with you and with Joe last week. I actually made a tweet this morning, and it's as you're going through things and learning, you don't quite remember what it was that you forgot. Mm-hmm. Does that make sense? So part of it is I'm hoping that this is going to help. Like, Keith mentioned about his wife, like his wife said before, it's like the people that you're talking to don't understand these things. So there's no point saying them or shouting them louder. They don't understand it. And part of that is because, and you've probably forgotten more than I know.
Yeah.
So it's like, in a way, you don't know what it was you had to get wrong right at the start to send you on the path to get to where you are today, right? So if we can get more people that are at different points in the process, that you're going to pull more people along with you, because everyone's going to be at different points, rather than Keith every day just standing there saying all of his stuff that he knows. There's going to be things that he doesn't even think about anymore because he's done the work or he's made the mistakes, and he doesn't spend time on it because he knows it doesn't work. But because it's been so long, he doesn't know that he's forgotten that, right?
Yeah.
So he doesn't know to bring it up, especially if he's talking to new people. New as in new on the journey, new on the path, journey. New having to learn all this stuff.
Right.
So that's I'm loving it.
Yeah. Chris, that's a great way to just end the episode right there, buddy. So well done, Trent. From the bottom of my heart, thank you again for joining today, for sharing this, for creating these decks. I think this deck in particular, I've got a whole slew of notes here, right, that I took down during this interview. And and again, I'm gonna have to review the tapes because I missed probably 70% of stuff I should have written down. So thank you again. It's been wonderful getting to know you better over the last few weeks, and I can't wait to continue to pick your brain on things, learn from you, and hopefully you'll be willing to come back on again and again and again over the course of the next few months, years, however long this journey takes us, right, Chris?
Yeah. Whatever I could do, and I want to learn as well. So #process, #HedgeNation.
Love it.
Have a great day, guys.
Yeah, have a good one. Thank you.